Imagine you discovered a small hole in your pocket, not big enough to lose your wallet, but just wide enough that, over the course of a single month, coins and small notes kept slipping out one by one. By the time you noticed, half your month's pay was simply gone. You would fix that hole immediately, wouldn't you? Here is the uncomfortable truth: most people already have that hole. It is not in their pocket. It is in their habits. Every unplanned coffee. Every subscription quietly renewing. Every small impulse buy that feels harmless in the moment. Individually, these are invisible. Collectively, they are devastating. Research across multiple countries consistently shows that the average person can account for only about 60% of what they spend in a given month. The other 40%? Gone without a trace. This audiobook is about finding that leak, plugging it, and then doing something extraordinary with what you save. By the time this audio guide is finished, you will know exactly where every single unit of your money goes, and you will have a plan to make it work for you instead of disappearing. Your money, your future. A complete audio guide to taking control of your personal finances. Adapted for audio presentation. Written by Mohammed Munib. Before we begin, 3 things that will change how you think about money. The person who started with nothing and retired with everything. Picture 2 people. Both earn the same salary. Both live in the same city. Both have similar expenses, similar families, similar lives. At age 65, one of them retires with financial freedom, money in savings, investments generating passive income, and no debt weighing them down. The other is still working, still stressed, still wondering where the month went. What separated them? It was not intelligence. It was not luck. It was not even income, because the research is clear that earning more money does not automatically make people wealthier. People who win lotteries routinely return to their previous financial condition within a few years. Income alone is not the answer. What separated those 2 people was a system. A set of habits, decisions, and behaviors practiced consistently over time. One person had a financial plan. The other did not. That is the only difference, and it is a difference every single person listening to this right now can choose to make for themselves, starting today. Financial freedom is not something that happens to lucky people. It is something that is built, one decision at a time, by people who choose to understand their money rather than fear it. The question that will make you uncomfortable. Here is the question. Take a moment before you answer it, because most people answer too quickly and lie to themselves. If you lost your job or your primary source of income tomorrow, how many days could you survive comfortably on your current savings? For most people, the answer is terrifying. Studies show that a significant portion of working adults across Europe, the Americas, and Asia could not cover 1 month of basic expenses without borrowing money. Not because they earn too little, but because the system, no matter what they have earned, they have spent almost all of it. This is not about shame. This is about awareness. Because awareness is where change begins. If that question made you uncomfortable, good. Hold that feeling. Let it motivate you through everything that follows. Because what you are about to hear is a complete, step-by-step roadmap for never having to feel that way again. The journey of 1,000 miles begins with a single step. The journey to financial freedom begins with a single, honest look at where you stand right now. Welcome. Let us begin. Part 1: Understanding Your Money. In which we discover what personal finance really means, why most people struggle with it, and how to build the foundation of your entire financial life. Chapter 1. What does it mean to be in control of your money? Let's start with the most fundamental question of all. What does it actually mean to manage your personal finances? Because for most people, those words conjure images of complicated spreadsheets, intimidating bank statements, and a vague sense of guilt. In reality, personal financial management is simply the practice of making conscious, intentional decisions about the money that flows through your life. Every adult already manages money in some form. The difference between those who do it well and those who struggle is not ability, it is awareness, and a willingness to create a plan. Think of your financial life as a river. Money flows in from one direction, your income, your wages, your benefits, your business, and flows out in another direction, through your expenses, your bills, your purchases. If you never pay attention to that river, it will find its own course, usually carving channels you never intended and leaving the landscape of your finances eroded and unpredictable. Personal financial management means you become the engineer of that river. You decide where the channels go. You control the flow. You make sure that enough water is always held in reserve for droughts, the unexpected expenses, the emergencies, the opportunities. There are 3 core pillars of financial control that every single chapter of this guide will return to. The first pillar is income management. The golden rule here is deceptively simple: spend less than you earn. Not dramatically less. Not punishingly less. Just less. If your outflow is consistently smaller than your inflow, you will, over time, build wealth. Violate this rule and no amount of investment knowledge or financial sophistication will save you. The second pillar is debt management. Debt is the opposite of wealth. It means you are paying tomorrow's money for today's pleasures. Some debt is unavoidable and even reasonable, a mortgage on a home that is appreciating in value, for example. But consumer debt, the kind that finances holidays and gadgets and impulse purchases, is one of the most powerful forces in the world for keeping people poor. The goal is simple: eliminate it as quickly as possible, and then commit to never returning to it. The third pillar is savings and investment. Your savings are your safety net, the cushion that protects you when life delivers an unexpected blow. Your investments are your growth engine, the mechanism by which your money makes more money, even while you sleep. Both are essential. We will spend a great deal of time on both. Here is what ties all 3 pillars together: planning. Without a plan, good intentions about money fade away within days. With a plan, even an imperfect one, you have something to return to, something to measure against, something to improve. As one financial educator memorably put it, a plan without action is just a wish. But action without a plan is just chaos. So before we go any further, I want you to commit to one thing. Not a big, dramatic life overhaul. Just this: by the end of this audio guide, you will write down 3 financial goals. They can be small. They can be simple. But they will be written. Because the act of writing a goal changes its nature entirely, it moves from a vague hope into a real intention. Chapter 2: Why we are the way we are with money. Understanding money management is one thing. Actually changing our behavior is another challenge entirely, and one that most financial books completely ignore. So let's talk about the psychology of money for a moment, because it will explain a great deal about why you feel the way you do about your finances. Human beings are not naturally rational about money. We were not designed to be. Our brains evolved for an environment where food was scarce, danger was immediate, and tomorrow was never guaranteed. Spend what you have today, because who knows if there will be a tomorrow. That impulse, hardwired deep in our psychology, is one reason why saving feels so counterintuitive to so many people. Add to that the powerful influence of social comparison. We are extraordinarily sensitive to what the people around us are spending. If our neighbors buy a new car, we feel the pull. If our colleagues go to restaurants we cannot afford, we feel the pressure. Advertising is a trillion-dollar industry precisely because it is extraordinarily skilled at exploiting these instincts, creating desire, manufacturing urgency, and making us feel that the purchase we are considering is not a luxury but a necessity. Understanding all of this does not mean we are helpless. It means we are human. And once we understand the forces working against us, we can put systems in place that make good financial behavior automatic rather than dependent on willpower, which, as every psychologist will tell you, is a depletable resource. The first and most powerful system you can create is this: automate your savings. Decide on a percentage of your income that you will save, even if it is only 5% to begin with, and arrange for that money to be transferred out of your main account automatically on the day your income arrives. You will not miss what you never see. Over months and years, this small automated action builds into something substantial. The second system is the written budget. Not a vague mental note about trying to spend less. An actual, documented budget, even a simple one, on a piece of paper or a phone app, that tells each unit of your money where to go before the month begins. Studies consistently show that people who maintain any form of written budget spend significantly less on non-essential items than those who do not, simply because the act of tracking makes spending visible. The third system is the cooling-off period for larger purchases. Before buying anything that costs more than you could comfortably lose, give yourself 24 hours. For larger purchases, give yourself a week. In the overwhelming majority of cases, the urgency fades and you realize you did not need the item as much as you thought. This simple practice can save enormous amounts of money over a lifetime. Now that we understand the foundations, what money management means and why it is psychologically challenging, let us move into the practical heart of this guide. Let us talk about the financial life cycle, how your needs change across the stages of your life, and how to plan for each of them. Chapter 3: The Journey of a Financial Life. Your financial needs at 20 are not the same as your financial needs at 40, and neither resembles what you will need at 65. Understanding the typical financial life cycle, the way income, expenses, and priorities shift across the decades, is one of the most powerful tools for long-term planning. In early adulthood, most people are dependent on parents or guardians. Income is low or non-existent. The financial priority at this stage is not yet accumulation, it is education, both formal and financial. The habits formed here, the relationship with spending, saving, and debt, will echo through every subsequent decade. This is why financial literacy education is so urgently needed for young people. The earlier the foundation is laid, the more powerful its effect. In the working years, typically the 20s through the 60s, income rises, expenses grow, and the great financial challenge is balance. This is the stage where most people are simultaneously managing housing costs, family expenses, debt repayment, and the increasingly urgent need to save for retirement. It is also, unfortunately, the stage when lifestyle inflation tends to strike most powerfully. As income grows, so does spending, sometimes faster, and the gap between what people earn and what they save can remain stubbornly thin. In retirement, the dynamic reverses. Income typically drops sharply, down to state pensions, private savings, and investment returns. Expenses, meanwhile, do not disappear. Healthcare costs tend to rise. The financial cushion that was supposed to have been built during those working decades now needs to be large enough to sustain a comfortable life for potentially 20 or 30 years. The critical insight from this life cycle perspective is this: the time to prepare for retirement is not when it is approaching. It is now, wherever you are in your working life. Every year of delay in building savings and investments is not just 1 year lost, it is many years of compound growth lost. And compound growth, as we will explore in detail later, is one of the most powerful forces available to any individual investor. Prosperity is not something that happens to you. It is built, steadily and intentionally, across a lifetime of decisions. And the most important decision you can make right now is to begin, wherever you are, with whatever you have. Part 2, Growing What You Have, in which we explore the multiple paths to increasing your income, from negotiating a raise to starting your own venture, and why volunteering might be the best financial decision you make this year. Chapter 4, More Money Coming In, the Income Expansion Mindset. Most people approach their financial problems from only one direction: cutting expenses. And while expense management is absolutely essential, we will spend a great deal of time on it. Focusing exclusively on cutting is like trying to fill a bucket by simply pouring less water out. There is a second lever available to you: pouring more water in. Increasing your income. There are 3 broad strategies for expanding your income, and the most effective financial plans combine at least 2 of them. The first strategy is optimizing your primary employment. This means ensuring you are being paid what your skills are worth, actively pursuing promotions, developing new competencies that make you more valuable, and negotiating effectively for raises. Research consistently shows that people who proactively negotiate their salaries earn significantly more over their careers than those who simply accept what they are offered. If you have not had a serious conversation about your compensation in the past 18 months, put that on your to-do list this week. The second strategy is generating supplementary income. This could mean freelance work in your area of expertise, a part-time job, selling handmade goods, monetizing a skill or hobby, or any number of digital age income streams. The gig economy, for all its limitations, has created genuine income opportunities that simply did not exist a generation ago. A few hours of additional earning each week, directed entirely into savings or debt repayment, can dramatically accelerate your financial progress. The third strategy is creating passive income, streams of money that require an initial investment of time or capital but then generate returns with minimal ongoing effort. Investments in stocks, bonds, or real estate. A small business that eventually runs without your constant presence. These are long-term plays, not quick fixes. But for anyone serious about financial freedom, building passive income streams is ultimately the goal. Chapter 5, Starting Something of Your Own. Self-employment and entrepreneurship deserve their own discussion, because they represent one of the most powerful, and most misunderstood, paths to financial independence. Let us begin with self-employment. To be self-employed means to be the owner of your own working life, answering to clients or customers rather than to an employer. The freedom is real and significant. So are the responsibilities. A self-employed person pays their own taxes, manages their own schedule, finds their own clients, and carries their own risk. For the right person, disciplined, self-motivated, and skilled in their chosen field, self-employment can be enormously rewarding both financially and personally. If you are considering it, the first step is honest self-assessment. Do you have a marketable skill that people will pay for? Can you sustain yourself financially during the initial period of building a client base, which often takes longer than expected? Are you prepared to handle the administrative and legal requirements that come with running your own income-generating activity? These are not reasons to avoid self-employment, they are simply questions to answer honestly before you begin. For those with ambitions beyond individual freelancing, for those who envision a business with products, employees, and growth, the planning requirements are more extensive. A solid business plan is not optional. It is the document that forces you to think through every critical dimension of your idea, who your customers are and what they actually need, how you are different from your competitors, how you will reach the people you want to serve, and crucially, whether the numbers make sense. On that last point, many brilliant ideas have been destroyed by flawed financial modeling. Before launching any business, you must understand your break-even point, the level of sales at which you cover all costs and begin generating profit. You must understand your cash flow, the timing of money coming in versus money going out, which can be fatally misaligned even in profitable businesses. And you must have a realistic picture of your startup capital needs and where that capital will come from. One practical piece of advice for aspiring entrepreneurs that is rarely given but enormously valuable: before you invest any significant money, try to sell your product or service to at least one real customer. Not a friend or family member who is being supportive. A stranger who has no emotional reason to say yes. If a real customer will pay real money for what you offer, you have validated your idea. If no one will pay for it yet, you have learned something important at very low cost. Chapter 6: The Unexpected Power of Volunteering. This might seem like an unusual topic in a personal finance audiobook, but stay with me, because the financial case for volunteering is stronger than most people realize. Volunteering is, at its core, a skills-building and network-building activity. When you volunteer your time and abilities to an organization whose work you care about, you are not simply doing good in the world. You are expanding your professional network into circles you would not otherwise reach. You are developing new competencies, or applying existing ones in fresh contexts that strengthen them. You are building a track record of achievement and responsibility that sits alongside your paid work history. For someone making a career transition, volunteering can provide the experience that employers want in a new field, without the impossible requirement that you already have paid experience in a field you are trying to enter. For a young person just starting out, it can create the kind of professional relationships that lead to opportunities. For someone who feels stuck, it can reignite a sense of purpose and energy that spills over into every other area of life, including the financial. There is also the matter of personal confidence. One of the most underappreciated obstacles to financial progress is a lack of self-belief, a quiet, persistent voice that says you are not the kind of person who succeeds financially. Volunteering, and the sense of competence and connection it builds, directly counters that voice. It reminds you what you are capable of. And capability, once remembered, tends to expand. The thread running through all three income strategies, employment optimization, entrepreneurship, and volunteering, is this: your income is not fixed. It is not a permanent number assigned to you by the universe. It is a variable that responds to your choices, your skills, your willingness to grow, and your capacity to create value for others. Wherever you are financially right now, you have more power to change it than you might believe. Part 3: Mastering Your Expenses. In which we build a complete picture of where money goes, why budgeting is not about deprivation, and the practical strategies that immediately put more money back in your hands. Chapter 7: Understanding the True Shape of Your Spending. Before you can control your expenses, you need to see them clearly. And seeing them clearly requires a framework, a way of organizing the complicated tangle of your spending into categories that are meaningful, comparable, and actionable. Let us begin with the broadest categories. Every expense you will ever incur falls into one of three fundamental types: fixed expenses, regular expenses, and one-time expenses. Fixed expenses are those that remain essentially constant from month to month. Your rent or mortgage payment. Your loan repayments. Subscriptions that renew automatically. These are the expenses that exist regardless of what happens in your life during a given month. They are predictable, which makes them plannable, and that makes them less dangerous than they might appear. You know they are coming. You can prepare for them. Regular expenses are those that recur but vary in amount. Your food costs. Your utility bills. Your clothing purchases. Your transport expenses. These are the expenses where the most opportunity for optimization usually exists, because their variability means they respond directly to your choices and behaviors. Spending €50 less per month on food through better planning and shopping habits saves €600 per year. That is not a trivial amount. One-time expenses are the purchases that happen occasionally and, if not anticipated, can devastate an otherwise healthy budget. The major appliance that breaks down. The car repair. The medical cost. The celebration or event. These are often the expenses that push people into debt, not because they are unaffordable in principle, but because they arrive unannounced and there is nothing set aside to cover them. The solution is simple in concept: anticipate them. Set aside a small amount each month into a dedicated, unexpected expenses fund. When the one-time expense arrives, you are ready for it. Beyond this three-part framework, there is another lens through which to view your spending: the question of necessity. Some expenses are genuinely non-negotiable: food, shelter, basic healthcare, transport to work. These must be paid, and optimizing them is a matter of finding quality at the best possible price rather than eliminating them. Other expenses are genuinely optional: subscriptions you barely use, habits that add nothing to your well-being, status purchases designed to impress people you do not particularly care about. These are the expenses to scrutinize most honestly. And between those two poles sits the most interesting category: expenses that feel necessary but are actually choices. The level of your grocery shopping. The frequency with which you eat out. The standard of your mobile phone plan. The size of your home. None of these are truly fixed. They are decisions you make, often unconsciously, based on habit, social pressure, and the failure to examine whether the cost matches the value you receive. Chapter 8: Building a Budget That Actually Works. The word budget has an image problem. To most people, it suggests restriction, sacrifice, and the joyless monitoring of every transaction. That understanding is wrong, or at least, deeply incomplete. A budget is not a cage. It is a set of instructions you give your money before the month begins. It is the difference between deciding intentionally how your resources will be used versus simply watching them disappear. Let us build a budget from scratch, clearly, step by step, in a way that you can apply immediately. Step 1: Calculate your total monthly income after tax. Include everything: salary, benefits, freelance earnings, any regular support. This is your working number. Every decision flows from it. Step 2: List every fixed expense you have this month. Rent or mortgage. Loan repayments. Insurance premiums. Regular subscriptions. Total them up. Subtract that total from your income. What remains is your flexible income, the money available for all other spending and saving. Step 3: Allocate your flexible income deliberately. A commonly used guideline divides it this way: roughly 50% for essential living costs like food, utilities, and transport, 30% for personal enjoyment and lifestyle, and 20% directed immediately into savings and debt repayment. These percentages are not sacred. Adjust them to your circumstances. But the principle behind them is absolutely sound: savings come first, not last. Here is the single most important insight about budgets and savings: if you wait to save what is left over at the end of the month, you will save almost nothing. Because the month will always conspire to consume whatever is available. Pay yourself first. Move your savings out of reach, into a separate account, ideally one that is not immediately accessible, before you spend anything else. Then live on what remains. Step 4. Track your actual spending against your budget throughout the month. This is where most budgeting attempts fail, because people set up a plan and then abandon the tracking. Tracking does not need to be burdensome. A simple phone app, a notebook, a quick weekly review, any system that keeps you aware of where you stand is better than none. The goal is not to make tracking feel like punishment. The goal is to make your spending visible. Step 5. Review and adjust at the end of each month. Look at where you overspent and underspent. Ask what caused the overspending. Ask whether the underspending was a sacrifice worth making. Over time, as you refine your budget through real experience, it becomes increasingly accurate and increasingly easy to follow. The first budget is always imperfect. That is fine. It is still infinitely better than having no budget at all. Chapter 9: Practical Strategies for Spending Less. Now let us get granular, because theory without tactics is incomplete. Here are the most effective practical strategies for reducing your regular expenses without reducing your quality of life. When it comes to food, typically one of the largest discretionary expense categories, the single most impactful change you can make is meal planning. Before each shopping trip, decide what you will eat for the coming week. Write a list. Buy only what is on the list. Cook at home more frequently. These 3 habits alone, applied consistently, can reduce food costs by 30 to 40% for most households. They also tend to improve health as a side effect. For transport costs, the question to ask is, am I paying for convenience I could replace with a small adjustment? Walking or cycling for shorter journeys, sharing car trips with colleagues, comparing fuel costs between nearby stations, these small adjustments accumulate over a year into significant savings. For housing costs, usually the largest fixed expense, the question is whether you are getting good value. This does not mean you should immediately move somewhere cheaper. But it does mean reviewing your utility providers periodically, investing in energy efficiency measures that reduce monthly bills, and being aware of whether the size and type of your housing still matches your actual needs. For subscriptions and recurring services, an area that has exploded in the digital age, conduct a thorough audit every 6 months. Make a list of every subscription you pay for and honestly assess how much value you extract from each one. The ones you barely use are quietly draining money that could be compounding in your savings. For entertainment and leisure, often the category that feels most personal and therefore most difficult to touch, the key is replacing expensive habits with equally enjoyable but cheaper alternatives, not eliminating enjoyment altogether. Many of life's richest experiences cost very little. The goal is never deprivation. The goal is conscious choice. There is one more expense strategy so counterintuitive that many people resist it, but the evidence is overwhelming: do not go shopping without a list and a purpose. Browsing in stores or online is not entertainment, it is exposure to a sophisticated commercial environment specifically designed to generate desire and spending. If you want to save money, reduce the time you spend in environments optimized to take it from you. Part 4, Managing Your Money Day to Day, in which we move from theory into the living reality of everyday financial life, planning for short, medium, and long-term goals, and building the habits that make financial health automatic. Chapter 10, Living Within Your Means, The Art of Daily Financial Management. Every day, you make dozens of financial decisions. Most of them happen so quickly, so automatically, that you barely register them as decisions at all. The coffee. The lunch. The taxi instead of the bus. The online purchase that appeared in a targeted advertisement. Each one feels trivial. Collectively, they define your financial life. Daily financial management is not about scrutinizing every penny with anxious intensity. That approach is exhausting and unsustainable. It is about building a framework within which daily decisions happen automatically and healthily, so that you are not making fresh choices under pressure every single time, but simply living within a structure that you have already created deliberately. Consider a concrete example. Someone earns a monthly salary of €400 after tax. They have just seen a smartphone costing €420. Can they afford it? The instinctive answer might be, almost, they are just €20 short. But this misses the point entirely. The question is not whether the purchase price exceeds their income. The question is whether, after making this purchase, they would have enough money left to meet all their essential needs for the month: food, transport, housing, utilities, plus maintain their savings commitment. Almost certainly not. The smartphone, in that context, is not a near-affordable luxury. It is a genuinely harmful purchase that trades a whole month of financial security for a consumer item. This kind of thinking, seeing purchases in the context of your complete financial picture rather than in isolation, is what distinguishes financially healthy people from those who perpetually feel behind. Here is a practical tool for developing that thinking. Before any significant unplanned purchase, ask yourself 3 questions. First, is this purchase budgeted for this month? Second, if I make this purchase, will I still be able to meet all my essential expenses and savings commitments? Third, will this item still seem worth the price in 30 days? If the answer to any of these questions creates doubt, wait. The wait almost always reveals whether the desire is genuine or impulsive. Chapter 11, Planning Across Time, Short, Medium, and Long-Term Goals. Financial planning is not a single, monolithic activity. It operates across multiple time frames simultaneously, and understanding the difference between short-term, medium-term, and long-term planning is essential for making your money work across your entire life. Short-term goals typically cover the next 6 to 12 months. They are close enough to see clearly and concrete enough to act on immediately. An example: you want to take a holiday next year that will cost €900, and you currently have no savings set aside for it. Working backwards, 900 divided by 12 months means saving €75 per month, starting now. That is a specific, measurable, actionable goal. Now compare that with using a loan to fund the same holiday. At a typical personal loan interest rate, a €900 loan repaid over a year might cost closer to €1,020 in total, meaning you pay an additional €120, plus potentially a loan origination fee, for the privilege of having the money now rather than saving for it. For a holiday, a pleasure that is over in 2 weeks, that is a significant premium to pay. Medium-term goals span roughly 1 to 5 years. Saving for a car, for a home deposit, for a significant career investment like further education. These goals require consistent monthly contributions over a longer period, which makes them more vulnerable to interruption, and therefore more dependent on automation. Set up an automatic transfer to a dedicated savings account for each major medium-term goal. Name the account after the goal if your bank allows it. Naming matters psychologically. It turns the abstract goal into something real. Long-term goals extend beyond 5 years, often to decades. Retirement is the obvious example. Consider someone who is 30 years old and wants to retire at 65 with a pension that supplements their state benefits by €300 per month. Over 15 years of retirement, that supplementary amount totals €54,000. To accumulate that through saving alone would require putting aside approximately €128 every single month, for 35 years, with no investment growth. If those savings are invested and grow even moderately, the monthly contribution required falls substantially, which is one of the many reasons why starting to invest early is so much more powerful than starting late. The overarching lesson from all 3 time frames is this: every financial goal becomes achievable when you break it into a monthly number and start contributing to it consistently. The goal that seems impossibly large from a distance becomes manageable, then normal, then almost automatic, when reduced to a monthly habit. Chapter 12: When Things Go Wrong, Managing Financial Difficulty. No financial guide is complete without addressing the reality that life does not always go according to plan. Jobs are lost. Health issues arise. Unexpected expenses land at the worst possible moment. Financial difficulty can strike anyone, regardless of how carefully they have planned, and the way you respond to it will determine whether it becomes a temporary setback or a lasting crisis. The first and most important step when you find yourself in financial difficulty is honest assessment. Not panic. Not denial. Assessment. Look at your complete financial picture: what you owe, what is coming in, what absolutely must be paid. Then categorize your expenses by priority. Housing and food come first. Everything else is negotiable, at least temporarily. The second step is to communicate, proactively and early, with anyone to whom you owe money. Creditors, landlords, and lenders have far more flexibility when a borrower reaches out before missing a payment than when they disappear and stop responding. Most creditors would genuinely rather restructure an agreement than pursue the costly and uncertain process of enforcement. Silence is the worst possible response to financial difficulty. The third step is to examine every expense ruthlessly and cut everything optional. This is the moment when the line between essential and non-essential must be drawn honestly and without sentiment. Subscription cancelled. Dining out eliminated. Entertainment budget suspended. The cuts may be temporary, but they must be real. The fourth step, if the difficulty is serious and ongoing, is to seek professional advice. Not from well-meaning friends or family, whose advice, however kindly intended, may be incorrect. From a qualified financial advisor, a debt counselor, or a social welfare professional who knows what support is available in your specific situation. And the fifth step, as soon as the immediate crisis has passed, is to build the buffer that will protect you from the next unexpected event. Because unexpected events will come. They always do. The difference between those who weather them and those who are devastated by them is almost entirely a matter of preparation, which brings us, perfectly, to the subject of our next section: financial freedom and the investments that make it possible. Part 5, The Path to Financial Freedom, in which we explore the world of saving and investing, understand how the Social Security system works, and discover the role that insurance plays in protecting everything you build. Chapter 13: What Financial Freedom Really Means. Financial freedom is a phrase that gets used a great deal, often in ways that are misleading or unrealistic. So let us be precise about what it means, and what it does not mean. Financial freedom does not mean having unlimited money. It does not mean never working again if you enjoy your work. It does not require being wealthy by anyone's definition. Financial freedom means having enough savings, enough investments, enough passive income, that you can make the important decisions of your life based on what you genuinely want rather than on financial desperation. It means that if you lost your job tomorrow, you would have breathing room. It means that when opportunities arise, a chance to travel, to study, to change careers, to support a family member, you have options rather than constraints. It means sleeping well at night. The path to financial freedom runs through three interconnected practices: saving, investing, and protecting. We will explore each one. Chapter 14: The Power and Practice of Saving. Saving is the foundation. Without it, nothing else is possible. No investment. No financial security. No long-term wealth. Just the permanent, grinding anxiety of a life lived on the edge of what arrives and what goes out. The core principle of saving is devastatingly simple: consistently put aside a portion of every amount of money that comes to you, before you allow yourself to spend it on anything else. Not at the end of the month, after expenses are covered. Before. Always before. If this sounds impossible given your current income level, start small. 5% is better than nothing. 2% is better than nothing. Even a tiny, consistent saving habit builds two things simultaneously: actual savings and the psychological habit of being someone who saves. That habit, once established, tends to grow. The vehicle for your savings matters as much as the habit itself. Cash kept at home earns nothing and is vulnerable to loss. A basic bank account is safer but typically offers minimal returns. A dedicated savings deposit account, a product offered by virtually every bank, keeps your money safe, accessible enough in emergencies, and earning at least some interest. Moving up from there, term deposits lock your money away for a fixed period in exchange for higher interest rates, suitable for savings you are confident you will not need in the short term. One of the most powerful tools available to any saver is time. Not high returns, not sophisticated strategies, not insider knowledge. Simply time. Because of compound growth, the process by which your returns generate their own returns, which then generate further returns, money that is invested or saved consistently over long periods grows in ways that feel almost magical. A small amount saved early in life, and left to compound, will outgrow a much larger amount saved late. This is why the single best financial advice that can be given to any young person is, start. Start now. Start with whatever you have. The size of the contribution matters far less than the consistency and the timing. Chapter 15: Investing, Making Your Money Work for You. Saving and investing are related but distinct activities, and understanding the difference is important. Saving is the act of setting aside money to preserve it, to have it available for goals and emergencies. Investing is the act of deploying money into assets that have the potential to grow over time, generating returns that accumulate into wealth. The three great enemies of savers who do not invest are inflation, opportunity cost, and time. Inflation means that money sitting idle loses purchasing power year by year. Opportunity cost means every year your money sits in a low-return account is a year it could have been growing more aggressively. And time, as we discussed, is the resource of which you have a finite supply. Let us walk through the main types of investments available to individual investors, understanding both what they offer and what risks they carry. Stocks, also called equities or shares, represent ownership in a company. When you buy a share of stock, you become a part owner of that business. If the business grows and becomes more valuable, your shares are worth more. If it pays dividends, a distribution of profits to shareholders, you receive a portion of those profits. Historically, over long periods, stocks have been one of the most powerful wealth-building tools available. But they come with significant short-term volatility. Prices rise and fall, sometimes dramatically, and an investor who needs their money during a downturn may be forced to sell at a loss. Stocks are therefore best suited to long-term money, funds you will not need for at least 5 years. Bonds are essentially loans you make to governments or corporations in exchange for regular interest payments and the return of your principal at a specified date. Bonds tend to be less volatile than stocks but also offer lower returns. They are the conservative's investment, appropriate for money that needs to be more stable and for investors who cannot afford significant fluctuations in value. Mutual funds pool money from many investors into a single portfolio managed by a professional. Instead of picking individual stocks or bonds yourself, you buy shares in the fund, which holds a diversified basket of assets. For most non-professional investors, mutual funds, particularly low-cost index funds that simply track major market indices like the broad stock market, represent an excellent combination of diversification, low cost, and long-term return potential. Real estate represents another well-established path to wealth, both through the appreciation in value of property over time and through the income generated by renting it. Real estate investing requires more capital than buying stocks or bonds, and it comes with its own set of risks and responsibilities. But for those who can access it, it has historically been a reliable long-term wealth builder. Across all investment types, the fundamental principle of risk applies. Higher potential returns come with higher potential losses. Investments that promise extraordinary returns with no risk are not investments, they are scams. Understanding and accepting the appropriate level of risk for your situation and time frame is the foundation of sound investment decision-making. And crucially, never invest in anything you do not understand. If you cannot explain clearly how an investment makes money, you should not put your money into it. Chapter 16, The Safety Net, Social Security, Insurance, and State Support. Financial planning does not happen in isolation. It happens within a wider system, the system of state support, social insurance, and private insurance products that exists, in various forms, in virtually every developed society. Understanding how that system works, and how to benefit from it appropriately, is an important component of any complete financial plan. State social security systems typically include several interconnected components. State pension schemes, funded through contributions made during your working years, provide a baseline income in retirement. Unemployment insurance provides temporary income support when employment is lost. Health insurance, whether state-provided or subsidized, protects against the potentially catastrophic cost of serious illness. Disability and incapacity benefits provide support when illness or injury prevents work. Family support measures help with the costs of raising children. Understanding what benefits you are entitled to, how to access them, and how they interact with your personal financial plan is not about dependency, it is about using the resources of the system you contribute to through your taxes and social insurance payments. Many people fail to claim support they are legitimately entitled to, simply because they do not know it exists or feel embarrassed to ask. Neither is a good reason to leave money on the table that could improve your family's well-being. Private insurance is the second pillar of financial protection. Life insurance, in its various forms, ensures that those who depend on your income would be provided for if you died. Property and home insurance protects the largest asset most people own. Vehicle insurance is legally required in most places and financially prudent everywhere. Health insurance supplements state provision in many systems. The principle behind insurance is risk transfer. In exchange for a regular premium, the insurance company agrees to bear a risk that you cannot afford to bear alone. When chosen carefully and priced appropriately, insurance is one of the most cost-effective financial tools available. The key word is carefully. Read what you are buying. Understand what is covered and, crucially, what is not. Ask questions until you are satisfied. The fine print of an insurance policy is not a technicality, it is the document that determines whether the product will actually protect you when you need it. Part 6, Understanding Debt and Borrowing. In which we confront the world of credit clearly and without fear, understanding when borrowing makes sense, when it does not, and how to protect your financial reputation for life. Chapter 17, Borrowing, Tool or Trap. Debt is one of the most powerful forces in personal finance, powerful enough to build a home, launch a business, or fund an education. And powerful enough, if misused, to trap a person in a cycle of payments, interest, and stress that takes years to escape. Understanding debt clearly, neither fearing it irrationally nor treating it casually, is essential financial literacy. Let us start with the most important distinction in all of borrowing, the difference between debt that builds assets and debt that finances consumption. A mortgage on a home is typically a debt that builds an asset. You are borrowing to purchase something that may increase in value over time, that provides you with shelter you would otherwise pay for through rent, and that can eventually become a major component of your net worth. The mathematics of a home purchase with a mortgage: when the property is well chosen, the mortgage is reasonably priced, and you can genuinely afford the repayments, can work in your favor over the long term. A loan to fund a holiday is a debt that finances consumption. The holiday is wonderful. It lasts 2 weeks. Then it is over, but the repayments continue for months or years afterward. You are paying future money for past pleasures. The experience is gone, the cost remains. This kind of borrowing, unless truly unavoidable, is almost always financially destructive. Between these two extremes sits a vast middle ground of consumer credit, loans for cars, for appliances, for education, for medical expenses. Each case requires honest, case-by-case analysis. The key questions to ask before any borrowing decision are these: is what I am buying with this loan still going to be present and useful when I finish paying for it? Can I genuinely afford the monthly repayments without compromising my other financial commitments? What is the total cost of this loan, including all interest and fees, compared to saving up and paying cash? On that last question, let us make the mathematics vivid. A car loan of €5,000 at a 20% interest rate, repaid over 2 years, might cost you approximately €7,300 in total. You are paying €2,300 for the privilege of having the car now rather than in 18 months. That is real money, money that could have gone into savings, into investments, or into paying off other debt. None of this means never borrow. Sometimes borrowing is genuinely necessary and genuinely reasonable. But it should always be a conscious, informed choice, not a reflex, not a response to advertising, and never a substitute for having savings. Chapter 18, Understanding the Cost of Borrowing. If you are going to borrow, and most people will at some point, you need to understand precisely what you are paying for the money. Because the advertised interest rate on a loan is rarely the whole story. The number to focus on is called the annual percentage rate of charge, sometimes abbreviated as APRC or APR. This is a standardized calculation that includes not just the interest rate but all the associated fees and costs, origination fees, mandatory insurance, administration charges, expressed as a single annual percentage. When comparing loan offers, always compare the APR, not the nominal interest rate. Two loans with the same nominal interest rate can have dramatically different APRs if one carries higher fees. There are two main types of interest rate in the world of lending. Fixed interest rates remain constant throughout the loan period. Your monthly payment stays the same from the first month to the last. This predictability is valuable for budgeting. You know exactly what you owe and when. The trade-off is that if market interest rates fall, you continue paying the higher fixed rate. Variable or floating interest rates change over time in line with market reference rates, typically the Euribor in European markets, which reflects the average interest rate at which major European banks lend to one another. A variable rate loan might cost less than a fixed rate loan in the short term, particularly when market rates are low. But it carries risk. If market rates rise, your repayments rise with them. For large, long-term loans like mortgages, this risk is significant and must be carefully considered. Beyond the interest rate, there are additional costs associated with most loans: a contract fee charged at origination, mandatory property appraisal costs for mortgage applications, notary fees for property transactions, and insurance costs that lenders typically require as a condition of the loan. All of these add to the true cost of borrowing. Before signing any loan agreement, add up every cost you will incur and compare the total to the amount you receive. The difference is the price of that loan. Chapter 19: Fast Loans, Pawn Shops, and the Highest Cost Borrowing. Not all loans are created equal, and some exist at the very expensive end of the credit spectrum. Understanding these products, and the situations in which people turn to them, is important, because the people most likely to use them are often those least able to afford their costs. Fast loans, sometimes called payday loans or speed loans, are characterized by their accessibility and their cost. They typically require minimal documentation, approve applications quickly, and disperse funds almost immediately. For someone in genuine emergency need, a vital expense, no available savings, and no access to conventional credit, the speed and accessibility of a fast loan can feel like a lifeline. But that lifeline comes at an extraordinary price. Annual interest rates on fast loans can reach several 100%. And because of the combination of high rates, short repayment periods, and penalty charges for late payment, borrowers who cannot repay on time can find themselves in a rapidly escalating debt spiral, owing far more than they originally borrowed, paying more each day that repayment is delayed. The practical advice is straightforward: avoid fast loans unless there is genuinely no other option. Before turning to one, explore every alternative: selling something you own, borrowing from a trusted family member or friend with a clear repayment agreement, accessing social support or an employer advance, or even accepting the cost of delay. Almost any of these alternatives is less expensive than a fast loan. Pawn shops operate on a related principle: you bring a valuable item, receive cash, and have the option to buy the item back within an agreed period by repaying the amount received plus a fee. The item is the collateral. If you cannot or do not repay, the pawn shop keeps it and sells it. The implicit cost of this kind of short-term borrowing is typically very high, as pawn shops price the cash they offer well below the market value of the items they accept. Again, a last resort, not a first option. Chapter 20: Your Credit History, the Financial Reputation That Follows You. There is one aspect of borrowing that most people understand far too late in life: the fact that every credit decision you make, every loan you take, every repayment you make or miss, every time you are late, is recorded and creates a permanent part of your financial reputation. Credit history is the record of how you have behaved as a borrower. Databases maintained by financial institutions and credit reference agencies track this information, and lenders consult it before making decisions about new loan applications. A strong credit history, one that shows a pattern of responsible borrowing and reliable repayment, opens doors. It means lower interest rates, easier approval, and better terms on mortgages and major loans. A poor credit history, one marked by missed payments, defaults, or excessive debt, closes those same doors, sometimes for years. The implications of this are significant. A decision to miss a loan payment because you chose to spend the money on something else, a decision that might feel trivial in the moment, can affect your ability to get a mortgage years later. The credit history system has a long memory, and it is not forgiving of casual irresponsibility. The practical rules for maintaining a good credit history are simple and worth memorizing. Always make every payment by the agreed date and in the agreed amount. If you anticipate difficulty meeting a payment, contact your lender proactively before the deadline, not after. Never take on more debt than you are confident you can service from your regular income, and read every loan agreement carefully before signing it, so you are never surprised by its terms. If your credit history has already been damaged by past difficulties, it can be repaired, but only through time and consistent responsible behavior. There are no shortcuts. Every month of reliable repayment adds a positive entry to the record. Every year without defaults allows negative entries to fade. It takes time and it takes discipline. But it is entirely achievable. Conclusion: your financial future starts now. You have now traveled through the complete landscape of personal financial management. From the psychological forces that shape our money behavior, through the practical mechanics of budgeting and saving, into the world of investment, social protection, and credit. It has been a considerable journey. Let us bring it all together into a single, clear picture. The foundation of all financial health is the same simple principle that has appeared in every chapter of this guide: spend less than you earn. Not dramatically less. Not joylessly less. Just consistently less. If you establish this as the unbreakable rule of your financial life, everything else follows. On top of that foundation, build 3 structures. First, an emergency fund, at least 3 months of basic expenses set aside in an accessible savings account, untouched except for genuine emergencies. This single buffer will protect you from the financial shocks that devastate people who live without it. Second, a debt elimination plan, a systematic approach to paying off all high-cost consumer debt as quickly as possible, starting with the most expensive and working down. Third, a regular savings and investment habit, an automatic monthly transfer into savings and, when the time is right and the knowledge is there, into investments that will grow over time. Around those 3 structures, add the protective layers: appropriate insurance, understanding of your state social support entitlements, and a clear-eyed relationship with credit that treats borrowing as a tool to be used sparingly and deliberately, never as a substitute for savings or income. And above all of this, keep returning to the question of your goals. What do you want your financial life to enable? What kind of future are you building toward? The specific goals matter less than having them, because goals give every monthly savings contribution and every spending decision a context and a meaning. They transform the sometimes tedious work of financial management from an end in itself into a means to a life you have actually chosen. The best time to start managing your money well was the day you received your first income. The second best time is today. You do not need perfect information to begin. You do not need a large income. You do not need to understand every investment product or tax rule. You need a plan, however simple. You need a first step, however small. And you need the discipline to take that step, and then the next, and then the one after that. Financial freedom is not a destination that some people reach and others do not. It is a direction you can choose to move in from wherever you stand right now. The choices that take you in that direction are not glamorous. They are mostly quiet, unglamorous, repeated actions, the budget reviewed at the end of the month, the savings transferred before anything else is spent, the loan payment made on time, every time, the impulse purchase reconsidered and declined. Over months, these actions become habits. Over years, habits become outcomes. And the outcomes, the security, the freedom, the options, the peace of mind, are worth every discipline along the way. This is the promise of personal financial management, not wealth as an end in itself, but a life in which money serves you, rather than a life in which you serve money. A life in which you have choices. A life in which you sleep well. Go build that life. Start today.